Here's a sentence that shouldn't be possible. The most famous company in artificial intelligence loses $1.22 for every single dollar it earns. Not in some startup's first month, at $5.7 billion in quarterly revenue. There's one number buried in OpenAI's files that explains it, and an IPO that's about to force the whole world to look. Let's be clear about something first. OpenAI is winning the popularity contest. ChatGPT pulls in around 900 million weekly users. The company is on track for roughly $30 billion in annualized revenue. By any normal startup standard, those are staggering, era-defining numbers. So when people hear OpenAI is losing money, they assume it's the usual story. A young company spending to grow, revenue not caught up yet. Throw more users at it, the logic goes, and eventually the profits show up. But that's not what's happening here. And this is the part that breaks people's intuition. For OpenAI, more usage doesn't move them toward profit. It moves them further away. Every new power user, every company that rolls out ChatGPT to its engineers, every viral moment, each one widens the hole. A business where scaling up makes the losses bigger is not a normal business. It's the opposite of how software is supposed to work. Software is supposed to be the magic where you build it once and sell it 1,000,000 times for almost nothing. So what is so different about AI? To understand that, you have to look at the one number OpenAI did not want public. For the first quarter of 2026, OpenAI's internal financials leaked, and they are brutal. The company brought in $5.7 billion in revenue. Good. But it posted an adjusted operating loss of around $7 billion in that single quarter. Sit with that. They lost more money than they made. The operating margin was negative 122%, which is a fancy way of saying that for every dollar OpenAI collected, it spent about $2.22 to do it. It burned $1.22 for every dollar earned. And that figure already strips out stock-based compensation. Add that back, and the real loss is closer to $8 billion. So where does all the money go? One word: compute. Every answer ChatGPT gives runs on staggeringly expensive data centers full of AI chips. Unlike normal software, the cost doesn't disappear after you build it. You pay it again on every single query, forever. That's why more usage means more loss. The product is the cost. That is the broken engine at the center of this whole story. And it would be survivable if OpenAI were alone. But it is being squeezed from two directions at once. Look up first. Above OpenAI sits Anthropic, the maker of Claude, and increasingly the company eating OpenAI's lunch in the enterprise. The numbers here are wild. Anthropic's annualized revenue run rate went from about $9 billion at the end of 2025 to roughly $47 billion by May 2026. That's a 422% jump in 5 months. And here's the part that has to sting in San Francisco. Anthropic is reportedly on track for around $11 billion in second quarter revenue and an operating profit of nearly $600 million. Read that again. In the same market, burning the same kind of compute, one of these companies is making money. So this isn't a story about AI being impossible to run profitably. It's a story about OpenAI specifically. Its cost structure, its free users, its prices. Anthropic just raised $65 billion at a valuation near $965 billion. It is not going away. So OpenAI is losing the profitability race to the rival above it. You'd think the answer is to raise prices and fix the margins, except they can't, because of what's coming up from below. This is the part most people miss. The deadliest threat to OpenAI isn't another giant. It's the floor falling out of the entire market. Meet DeepSeek, and the wave of open source models like it. DeepSeek's models cost somewhere between 35 and 100 times less per token than OpenAI's top model, not 10% cheaper. 35 to 100 times cheaper. And the brutal truth that everyone in the industry is quietly admitting, for most real tasks, they're nearly as good. Maybe not the absolute frontier, but close enough that paying 10 times more is getting very hard to justify. Two things make open source models this cheap. They're open, so you can run them on your own servers instead of renting an API. And they're far smaller, with fewer parameters, so they burn far less compute per answer. That creates a permanent gravity on prices. Even if nobody switches today, the mere existence of a near-free alternative drags what everyone can charge towards zero. You cannot raise prices into that. You can barely hold them, which sets up the exact trap OpenAI now finds itself in. So picture OpenAI's position. It's losing billions a quarter. A profitable Anthropic is pulling ahead above it. A swarm of near-free open-source models is pressing up from below. On June 10th, the Wall Street Journal reported the move almost everyone expected. OpenAI is considering drastic price cuts on its tokens, the metered, per-use billing it charges developers and companies, specifically to keep customers from defecting to Anthropic and the cheap alternatives. Here is the problem with that. OpenAI already loses $1.22 for every dollar it makes. Cutting prices doesn't fix the losses, it pours gasoline on them. Every token they sell cheaper is a token they lose even more money on. And the usage is genuinely staggering. OpenAI reportedly keeps an internal leaderboard where employees compete to burn the most tokens. One engineer claimed to have run through 2.5 billion tokens in a single week. That's the culture at a company that loses money on every one of those tokens. They're not just in a price war, they may be forced to fight it at a loss, which would be a private problem if they were staying private. But they're not. OpenAI has confidentially filed its paperwork to go public. An S-1, lodged with the SEC, with Goldman Sachs and Morgan Stanley steering, reportedly targeting a debut as soon as September at a valuation somewhere between $730 and $850 billion. Some analysts think the listing could push it past $1 trillion. A confidential filing lets a company start the IPO process without immediately showing the public its revenue, its margins, or its risks. But that's temporary. To actually sell shares, OpenAI will have to open the books, fully, publicly, in detail. And that is the moment this whole story comes due. The negative 122 margin, the $7 billion quarterly loss, the price war eating the rest, all of it, printed in a prospectus for every investor on Earth to read. The number OpenAI didn't want public is about to become the most scrutinized figure in tech. The question is what the market does when it finally sees it. So here's the whole squeeze in one breath. OpenAI makes about $6 billion a quarter and loses 7 because every answer runs on compute. It pays for over and over. Above it, Anthropic is somehow turning a profit and racing ahead. Below it, open source models like DeepSeek do nearly the same job for a fraction of the price, dragging the whole market towards zero. And the only obvious move, cutting prices to compete, only makes the bleeding worse, right as it walks into the most public financial exam there is. None of this means OpenAI is doomed. It has the best-known product in the world and very deep-pocketed backers. But it does mean the thing everyone treats as inevitable, that the AI leader is a money machine, has it exactly backwards. The technology is winning, the business model is the question. If that reframed how you see the AI race, subscribe to Left Curved AI. We break down the business behind the hype, one doodle at a time. Next up, how Anthropic is actually making money where OpenAI can't. Thanks for watching.